let's talk about the space which arguably has performed the best and where the promise of profit performance seems to be the strongest. What's your sense on how did banking deliver?
Right. Yeah, so performance and promise. So I think performance relates more to growth so far, and the promise relates a lot to margin in the coming quarters. So clearly, what surprised the most from where we were at the end of 4Q was the extent of growth pickup in the sector. So if we look at the banking sector growth today, year to date, and we look at year to date because that adjusts for any base effects. So then that's the strongest since FY11 at about 4% year to date. So, and it's not just limited to banks, we are seeing it in NBFCs as well. The one area of a slight disappointment in the quarter was on the OPEX front. So we had, while till the previous quarter, selectively some banks were seeing an increase in operating costs, but this time it became more pervasive. One positive which was expected was that asset quality was pristine across all lenders. The exception in this was maybe Mahindra Finance, which had to make additional provisions, but even they saw better than seasonal movement in stress. For the coming quarters, the key thing should be how does NIM perform? And for the last quarter, this was to a large extent a non-event, but this will be a key driver of relative performance in the coming quarters, in my view.
Okay, interesting. So there are some banks which are well placed on the NIM expansion side, some which are not so, but there the other factors might be at play. So where does this thesis of how the coming quarters are based squarely, largely, not squarely, on NIM expansion leave what could happen going ahead, Aditya, to the fortunes of individual banks? Say ICICI, say some of the others.
Right, yeah. So one at a sector level, this is the first cycle where we are seeing rate expansion after the repo linking of loans, which happened from 2019 onwards. So in the previous cycles, when floating rate loans were linked to MCLR or base rate, those benchmarks move to a large extent in line with cost of funds of banks, while the repo rate obviously is moving much faster. However, the loans reprice with a lag. Typically, there's a 1 quarter lag period over which loans reprice. So we should be seeing that in the coming quarters. So that's the fundamental positive which should play out for the sector. You have a material increase in the lending rates, at least on the floating rate loans. While on the deposit side, we are still to see a large increase in rate. Just as one data point, SBI's 1-year term deposit rate is nearly the same as the repo rate. So there is a fairly widespread. It's completely a timing game. It has to normalize in the coming quarters eventually. But over 2Q and 3Q, we should be seeing material NIM expansion. Now, the banks that you want to be in that are those which have a more retail-oriented deposit base, a high CASA. Within a high CASA, preferably a high current deposits, because saving deposits will shift to term deposits to a large extent. Also a high liquidity coverage ratio. So that gives them ability to replace bonds with loans. On the basis of these criteria, the one bank which is a top pick is ICICI, which checks off really well on a lot of these criteria. For mid-sized banks, the retail nature of deposits is slightly less as compared to large private banks. So there you might have more rate shopping and perhaps less. They might have to increase their deposit rate slightly more. For PSU banks, while the CASA is really high, it's driven to a large extent by current deposits, by saving deposits and not by current deposits. Okay. And therefore, our preference right now is for large private banks still. And within that, ICICI is a topic.